You're predicting a $10 to $20 oil. I mean, that's illuminating.
Well, the point is that you've got an excess supply situation, and it's getting even more so because American frackers are adding oil faster than OPEC can take it out, and OPEC they're really beginning to start to cheat on themselves. Production in Saudi Arabia was up last month, as you probably know, and of course, the longer this goes, the harder it is for them to keep that agreement together to cut this 1.8 million barrels a day. And the point is that it's inventories. If they can't reduce those inventories, and so far they haven't been able to, then the downward pressure is on prices. And when you look at what is the marginal cost when you're in a price war, it isn't the average cost, the full cycle cost of getting the stuff out of the ground. It isn't meeting the budgets. It's the marginal cost. Once the holes are drilled, the oil is flowing. What does it cost to get to market? And in the Permian Basin in Texas, that's 10 to 20 bucks a barrel, and it's even less in the Middle East.
So you have this bearish forecast of $10 to $20 a barrel for oil. We're not there yet, but we've seen oil prices drop earlier this year, and it didn't drag down equity prices. Why not? Well,
actually, on balance, if you look at this since they started in on this program, you go back to November of 2014, there has been a positive correlation between oil prices and stocks. In other words, if oil prices go up, stocks go up, and balance. And if oil prices go down, stocks go down. Now, you would think the reverse, because we're still an oil importing nation. So lower prices mean lower oil bills, more money for people to spend, business, consumers, and so on.
Right, that whole tax cut.
So it says there's something else that's overshadowing this effect, and I think it's probably the financial risk, not for the major oil companies, but for many of the medium and smaller ones. And we saw a number of them go bust when oil prices collapsed 2 years ago. I think that's what's going on. Is you really have this problem. As a matter of fact, even if we take the oil out of the S&P 500, we find these positive correlations still exist. We just wrote this up in our monthly newsletter for this month, as a matter of fact.